So, talking about first lien HELOCs, we're going to talk about what isn't a first lien HELOC. So, a 30-year mortgage. A 30-year mortgage at the end of the day is going to be the standard loan product, whether it's a conventional FHA or VA loan. They are phenomenal products to help you get into buying a home. By no means am I anti 30-year mortgage. Heck, I have a 30-year mortgage. It's on a rental property. I got it when we had those impossible interest rates of 2 and some change. It's not a terrible product, but it helped me get into my first home. When I bought my first home, I put a half of 1% down. I live here in Idaho. That is a program that allows for individuals to buy homes and get into a home. Fortunately, that property started to grow and appreciate. And later down the road, I was actually able to do a refinance and I got myself into this all-in-one loan. So this all-in-one loan, really, what is it? So this product is a mortgage that is a line of credit that is also paired with a checking and savings account. The birthplace of wealth in any household is going to be in their checking and savings account. And funnily enough, more money will pass through an individual's checking and savings account in a 5-year time frame than what they typically owe on a home. However, because this product that we're utilizing is not just a checking account and a HELOC, and you have to do all of this manual labor behind it, we've merged those two together. So instead of you earning your money in your checking account with, let's just say, Wells Fargo, and every month you pay your mortgage payment and you're pulling funds from here and you go, gosh, we were only able to save 500. Gosh, we only saved 1,000. Oh, we were able to save $2,000 this month just to be hit with needing to buy new tires for your vehicle because you popped some when you were going on that dirt road. This product allows for us to take the money that you're earning, that you're waiting to spend, and in the meantime of waiting to spend it, it is actually going to be sitting against your home. So instead of it just sitting in your checking account, letting the bank use it and charge you by lending you out money, we're actually saying, hey, the bank doesn't get to use it at all. You get to use all of it. And that money essentially is going to be sitting in your actual mortgage. So to kind of get a better understanding of this, as you earn your money, it goes directly into this checking account paired with your mortgage. Now, yes, you can buy a home in this product. Yes, you can refi into this product. You can do second homes, investment properties, obviously primary residences. But as you earn your money, 100% of your dollars that you earn actually get deployed into your mortgage balance. And now that you owe less because that money is now sitting in your home, your payment on your home is based off of what you owe. A 30-year mortgage is going to be based off of what you borrow. If you bought a home and you have a $400,000 loan amount, whether it's month 1 or 121, your payment's always based off of $400,000. Whereas in this loan, as that balance comes down, your payment comes down with it. As that payment comes down with it, most people aren't inherently going to be spending that extra money on something else. I mean, if you guys were to save an extra $500 this month and didn't have to deploy it anywhere, you wouldn't just go and say, great, I'm going to go spend it on this and I'm going to go spend it on this. It's just sitting against your home in this loan, 100% accessible for you to use. But while you're waiting to use it, it's working for you. Now, obviously, as you continue to deposit your money into that account and that balance goes down, you can then deploy it for other things. So if you wanted to go and buy solar panels, again, I'm going to kind of bounce off of what JJ was saying a few minutes ago. You can go and deploy it for buying a vehicle. And I would defer to JJ on this because he's going to be the CPA expert. But part of the guidelines with this product is that it appears to be, not appears to be, but it is perceived by the IRS as a 30-year mortgage. It's considered amortized by how we calculate it on the back end, and I'll explain that to you in a second. But you will receive a 1098, which is that interest deductible form that you're going to submit on your tax returns to write off that mortgage interest. And if you don't deduct that, then if I went and spent money on this phone and my balance now went up, technically I am going to pay a small amount of mortgage interest on my purchase of this phone, vehicle, motorcycle, rental property, whatever you're looking at buying. And now you can kind of treat not only your business as a business, but you can treat your home as a business. By earning money, you pay the balance down. deploying it for whatever investment, whole life policy or whatnot. And now you can have that little bit of increased interest. Yes, you're having an increase in interest, but if you're putting it in smart investments, then realistically, you're going to be able to not only have that thing you deployed it into make you some money, but you're also going to be able to write off a portion of it, which I just find incredibly fascinating. Now, obviously, the way that this loan works, to get really, really granular, is that it takes the balance of your home on a daily basis. Whatever you owe, it multiplies it by the interest rate, and then it divides that day by 365. It adds it up over the course of the month, and that is what your collective mortgage payment is. Your payment is an interest-only payment. Comes out on the 21st of the following month, as you can kind of see in this image. But the people get so confused with this loan by saying, well, if it's interest only, how am I able to pay my home off? That's because the mind shift that you were told before is, oh, it's just an interest only payment. Oh, it's an adjustable rate mortgage. Those are bad. They were bad when treated in a 30-year mortgage. But with the product like this, the interest only payment is not based off of, again, just this arbitrary amount. Your paycheck, 100% of your money gets deposited into your mortgage balance. In many instances, you hear people say, well, if I save $2,500 every single month, couldn't I just do this in my 30-year mortgage? You certainly could put $2,500. Every single penny you save at the end of every month, you could apply that to your mortgage. You're kind of missing out on a few things though. One, you lose access to it completely. Two, the fact is that you're not going to change your mortgage payment by only putting in an extra $2,500 a month. And three, statistically, it's very unlikely that any household is going to take a net zero in income versus expenses and apply every single dollar to their mortgage. So you may not be 100% efficient by saying, well, I'm only going to apply 500 because I still need some money over here in case something comes up. This lets you get access to both worlds. You use every dollar you have and it goes to your mortgage, even money you're going to spend on credit cards in 10, 15 days. And then when you need it, you pull it out. So it is a 100% efficient product in the sense that your money is working for you the second you earn it, all the way to the second that you spend it. Now, as you can imagine, as that balance goes down and you open up that available equity, just like any other checking and savings account, you can pay your credit cards, you can pay other bills and auto pays and so on. So if you imagine what happens is your balance is here, you earn your money, whatever that dollar amount is, and it goes into your mortgage balance, paying it down. But then as you go through the course of the month, you go, well, I still need to spend money on my credit card and my insurance and so on, and you pull the money out. And as long as you're spending less money than you earn at a monthly basis, and you see that trajectory going down, your balance kind of does this zigzag like this. And a product like this, for the right people, on average, actually end up paying their home off in between 5 and 10 years without changing how they live at all. Again, there's certain requirements for this product, and we'll get into that here in a second, but really it's just a different way of calculating the math. Instead of putting the money into the bank's pocket, it's going into your pocket, something that you can use, and it doesn't allow the bank to take advantage of it by lending it out at a higher interest rate to you. I mean, I would be very interested if anybody in the chat would be able to say what they're earning on their checking account. I'm confident that their earning is going to be 0.001%. It's very, very minimal, but that same bank is going to take that money and lend it out to you at 6.5. So you're earning this much and the bank is earning this much. Imagine if you were no longer allowing for the bank to earn this much and instead we move that over to you. That is the power of a product like this. So the product is a 30-year product. For the first 10 years, you have access to the full line of credit. Let's just say for easy math, the value of your home is $500,000. That means, and I'm pulling up a calculator over here, that means that you'd get a line of credit of 80% of the value of your home. Meaning that for the first 10 years of this product, you would have access to a $400,000 line of credit minus whatever you owe. So if you've paid your home off in year 8, you have access to all $400,000. But in the remaining 20 years of this product, as you can see on that slanted line, the available line of credit decreases by 1/240th, which 240 is just 240 months is 20 years. What that means is that at year 15, instead of having access to $400,000, you'll have access to 75% of that, 300. At year 20, you'll have access to 50, and 25, you'll have access to 25% of the total line of credit. So this is the part where we are able to consider this loan as amortized. Now, yes, you could refinance into this product again at year 8, 9, 10, 15, whatever. Statistically, it's unlikely that people are going to remain in a home for 10 years, which is why banks' amortization schedules are such front-loaded, so that when you're in a home for 7, 8 years, you're spending something like 40 or 50% of the total amount of interest in just this small time frame, the time frame that you're going to be living in the home. It's just kind of highway robbery at the end of the day, and it is really unfortunate to see that so many people, there's those who shall not be named, and you can check out, again, we have a YouTube channel. There's so many people that say, oh, you need to have 20% down, you need to buy everything in cash, you need to pay your home off as fast as possible, but you need to be in a 30-year mortgage product. All of these things are not helping you, they're hindering you, because over that 15 years, you could have been paying your home off in a 30-year mortgage. You could have been using that to deploy in other income generating activities. I mean, when talking with Chris Noggle and Christy Vann, as they've kind of really taught me on how myself and my family can utilize this product, it is insane the amount of individuals that just go out there and say, I'm just going to do it this way because that's what my mom told me, and that's what my mom's mom told me, and that's how it's always been, and that's how it's always going to be. It's really trying to shift the way you think about not only your money, but your expenses as well.